Daniel. So what makes insurance debt so attractive for you?
Well, insurance has been an industry that has been stable for a long time. Almost for 200 years, it's been a mainstay of developed economies. And it has been the same companies. So if you look at the largest companies, they've been around for 100 years, 200 years sometimes. And that hasn't stopped a lot of newer companies coming in as the marketplace has continued to develop. So there's almost 5,000 insurance companies in the developed world, meaning Western Europe and the US. And in that whole entire area, a lot of regulation. The government is interested in protecting the consumers. And what harms the consumers? Well, if you have an insurance company that fails, it harms the insurers. So it's the industry that has the lowest percentage of speculative grade debt. So almost everybody is investment grade who is rated. It's an industry that has very, very low default rates. And it doesn't really obey the rules of looking at what a good company is from the ways that people are looking at private debt lending. And that means for the smaller companies, I mean, everybody's knowledgeable about the largest companies. The smaller companies, which may own the policies, may insure people without them even knowing for different parts of what they're doing, those smallest companies often can be modestly profitable but very long-lived and very economically stable without all the indicias of being a great company. These are not great companies that are becoming technologically superb. They're good companies that will last a long time. If you can get over a long period of time, which is what we love, rates that are between 635 basis points above LIBOR and 750 over LIBOR, it's a great area to be in.
And what does that mean for return for investors?
Well, it means you're really getting almost a 10% return without any leverage. So if you compare us to almost every other investment class, we're happy to talk about our returns just on an unlevered basis. We invest in the insurance companies, you get a 10% return without any leverage. With leverage, you can get in the mid-teens, and that's very attractive for people.
Well, and obviously, you guys are investing in one sector. I mean, how do you guys manage diversification risk?
Well, it's really, if you look at it, insurance is universal. It's like saying, okay, we're going to make a sector of all of the companies that use cash or all of the companies that accept credit cards. Because isn't that all the same? Well, it's the same as a credit card terminal or credit card processing. It's in every sector. And there's lots of different things we insure that have nothing to do with each other. Somebody's health insurance has nothing to do with workers' comp, has nothing to do with the property and casualty risk in Florida or California, has nothing to do with other excess and surplus lines. When you have a warranty, that's a completely different sector. They're all regulated, they're all geared towards protecting the consumer. So that's the protection that we get even before we start to look at the credit quality of an insurance company. That's where we start, and where we finish up is that we think that there's an opportunity for people to have great performance. Ultimately, if you're getting in the range of 8 to 10%, what you want to make sure is that you have as few losses as possible, right? And if you have few losses, then with some leverage you can get some spectacular returns.
And whereabouts are you guys finding the best opportunities in the sector?
Well, we've been doing this for 15 years, so we have a network of people and companies that we work with over time, some very strong originators who have been going directly to companies. We've financed more of these companies than almost anybody else out there. We've financed them, certainly we're probably the only people who have done this in 32 states, and there are only 32 insurance states that really count. And 17 European countries. And so our familiarity with being able to go through the regulatory process with the insurance company means that we are constantly out there talking to companies, and we think seeing the best transactions that can get done. And our biggest problem is we'd like to have more companies want to do the transactions. There are people who are investing alongside of us who do these things on a one-off basis and who mix them into insurance-linked securities funds. And we think they're getting a great return, and we think it's a great way for the insurance companies to increase their capital availability.
And what about some of the challenges in the sector?
Well, the challenges are primarily origination. I mean, if we look at the underwriting, it's a challenge for a generalist who may be used to looking at a company's cash flow, what's the multiple of EBITDA. It also may be a challenge to an asset-based lender because you can't really secure the credit. But if in terms of looking at it as a specialist, the biggest challenge is to find the companies who want to do this and then price it correctly. There's an implicit pricing gap in this particular sector, and we'd like to keep it that way.